Welcome to the Millionaire Journey Podcast. The goal of this podcast is to guide and empower you on your journey towards financial independence. Here's your host, Glenn Yaney.
Today, my guest is Mario Dattilo with Equity Growth. Welcome, Mario.
Hey, Glenn, how's it going? Thanks for having me on, man. I'm excited to do this interview.
Yeah, you're like one of the first mobile home influencers I ran into on LinkedIn, and quickly afterwards, it's like everybody else starts crowding the scene. But I was telling you before the call how you have all these education things that was pulling me into is great.
Yeah, I love the fact that it works, and whether you like me or not, at least you know what the heck I do, right? That's
Yep.
that's the whole goal. Love me or hate me, if you want to do something with me or not. So
Yeah, we got
love it.
about a year's worth of podcasts under the belt, so I figured I could start getting more established people, on the call.
Love it. I'm happy to be on, and I think we're gonna have a great conversation. I know you're in the manufactured housing space as well, so definitely can have some fun talking about that. Been doing it a long time, so yeah.
Yeah, so if you could just tell us how you got into real estate and just
Yeah.
getting to where you're at.
So, barely graduated high school, probably on the list of likely to fail, not likely to succeed. Started a business at the very end of high school. It was a network marketing business and did very well with that. For some reason, that was like a major shift in my life. I realized that I could, have a successful lifestyle and do something with my life without having to get, another 4 years of college. So I actually never went to college, just started a business late senior year of high school and did well with that. Few years later, the company that I was contracted by or that I had the business through filed bankruptcy. Completely wiped me out. All my income stopped immediately. It was just horrible. You build a team of like 1,500 people and had this whole infrastructure, and they just go, "Yep, we're keeping your customers. Have a good day." I'm like,
Oh,
wait a minute, that's not cool. So
yeah.
I learned a really good lesson early on, and that's I need to be in control. Even though I thought I was in control, I thought I was a business owner. Ultimately, I was contracted by another company, and they controlled me. Right. So learned a great financial collapse lesson at very early in my life, and it's made me a much more conservative investor and entrepreneur since then. But after that, I had to kind of figure out another business, right? And so 2000, call it six, I want to say 2005, everybody's in the mortgage business. So a partner of mine and I started a mortgage company. And shortly after, we started a real estate brokerage. And the funny thing is, I had no experience with real estate other than I'd like wholesaled a couple of houses or something. And we started talking about starting a brokerage. I'm like, I'll run that because I liked it way more than the finance side. I hated the mortgage side. It was boring to me. And so started that real estate brokerage. And the funny thing is, I didn't even have a license when we started the company. We partnered with an old timer that had a broker's license and he wasn't active. And we said, hey, we're going to start a brokerage with you. Let's use your license. I'm going to go get licensed really quick as an agent and I'll recruit the whole team. I'll run it. And I was the managing partner of that brokerage. So it worked out pretty good. And then in 2008, kind of saw the whole market crash. And at that point, I'm helping investors like buy distressed property and sell it. Man, these guys are making a killing, and I'm basically helping them do that. So I went to my dad, who was in commercial construction and was a custom home builder many years, and said, look, you handle the construction, I'll do the rest. And we partnered and shut down the brokerage. And from then on, flipped houses till about 2012 when we said, you know what, this flipping game sucks. It's a lot of work. And we got to keep finding inventory, which when the distressed stuff dried up, it was knocking on doors and things like that. So we looked for commercial property and stumbled into mobile home parks and bought our first park in 2013, end of 2013-ish. And ever since been buying parks, storage, RV parks, and some light industrial, small bay stuff.
And where were you buying the parks at? What location?
Well, it's funny because a buddy of mine calls me who is a commercial banker. And he goes, hey, I know you're looking for apartment buildings and other stuff, but got this trailer park you might be interested in. It was a non-performing loan on a park, and it was a local bank that had the loan. And I'd bought a fair amount of non-performing debt in the single family space before. And so I looked at it and it had just crazy code enforcement liens, over $1 million worth of code enforcement liens on.
Wow.
So every time people would try and buy it as a short sale, guy owed like 4.2 million on it. He was a developer. He bought it to redevelop. Market fell out from underneath him and he basically got stuck with an asset and way over leveraged. But nobody could buy it as a short sale because every time they do the title search, they'd realize, crap, there's all these code enforcement liens. So we went and negotiated a deal with the code enforcement. We obviously negotiated a pretty sweet deal on that note. We bought it, foreclosed on it, took it back. That was the first deal. And we're like, oh crap, this is interesting. This is a really different business than the apartment space, which is what we thought we wanted to get into. So kind of stumbled on it. And I'm really thankful I did because game changer.
And that was is that in Florida as well, where you bought
That
that
was in
park?
Naples. Sorry, I didn't even answer your question
Yeah, yeah,
for
yeah,
like
yeah.
5 minutes, but yeah, that was actually in my backyard. I live in Naples now, and that was really a solid location, and I'm really glad it was because I think that's what got me comfortable. I knew that regardless, the dirt was worth more
Yeah.
than what we were paying,
Yep.
and so that's kind of what got me comfortable to research it and pursue it, and then now I own in 6 states. So, but yeah, that was in my backyard.
So how did you decide to pivot to going outside of your state?
That's a really good question. Nobody's asked me that. I think what happened was we were looking around Florida, we were buying around Florida, and then somebody brought us a deal in the Atlanta market.
Mm,
And, it's pretty close, right? And so we started researching that. We like Atlanta. I'm not a huge fan of the rest of Georgia, but Atlanta's good. And so we picked that up. And then I think it just organically happened. I'm from Minnesota originally, and a deal came up in Minnesota. And I'm like, wait, this is a pretty good deal in a really good location. So we bought that. And then I think we just got comfortable with the fact that we're not only going to buy in Florida. And we're like I said, we're in 6 states now and all kind of spread out. And that's right. We started out kind of more from a sniper approach. We would pick a market, we'd farm it, we'd work it, and then we'd find a deal and we buy there, right? And then we switched to more of a shotgun approach where we market much more broadly, which is social media and other things, and look at the opportunity now first. Look at the location. If we like the location, we'll buy the asset, and then we try and accumulate other assets around it.
yeah. So uh, when you buy in another state, are you looking for like a certain size deal? Of course, you're not buying like a 10-unit deal out in
Right.
Minnesota.
Yeah. I mean, I think really 50 plus occupied lots is where we start to get interested almost anywhere, unless it's like right down the street from one of our other communities, then it might make sense to bolt on.
Yeah,
But generally speaking, 50 or more occupied sites, if you're going to be out of state, we really don't own too many in like low rent areas. So if the rents were like $300 a month, it's pretty hard to make
yeah,
those numbers work. We do own one in Pennsylvania, which that is our lowest lot rent community. And we're just about to be hitting 400. I think we might even be at 400 now after the first, but that's our
yep,
lowest lot rent community. So if you're going to go small, you need to go higher lot rents because really what it comes down to is revenue, right? Forget
yeah.
the
Of
number, the
course.
count. But generally speaking, 50 or more occupied lots is where we get interested in looking.
So how did you go about finding the money to buy a mobile home park
Yeah. So that deal, I'll tell you the story on that deal. We bought that deal really, really cheap. I bought that park for like 625,000. Okay.
in Naples?
And yeah, and
Yeah,
actually it was 750. And then we went to the borrower and said, hey, you owe us $4.2 million, and we're going to hold you personally accountable for that loan unless you want to work something out. And he said, yeah, let's do it. So we ended up getting like 130-ish thousand from him over the next 9 months in 3 payments that reduced our basis down to roughly 625. Those numbers are close, right?
yeah,
And with that deal, I got an investor. It was funny because everybody thinks like, what if I don't have the money? How am I going
yeah,
to buy these things? They're big deals, whatever. I didn't have all the money to do it. And everybody that I went to that I'd been talking to about buying apartments and other commercial property was kind of like on the sidelines. They were like, yeah, sounds good. Timing's not right. It's funny. Everybody says they're very interested in investing with you when you find a
yeah.
deal, but when you put a deal in front of them, everything else comes up, right? And so I ended up calling other guys in our market that were in real estate that I didn't even know and be like, hey, I got this deal under contract. I'm looking for a good strategic partner.
Yeah.
And I ended up partnering with a really good guy. He's a hospital developer. He developed all kinds of like assisted living facilities and just a really solid guy locally. And he took a chance on me and he put up the equity. We put a little cash into it as well. And yeah, so we ended up buying that, and within a year we refinanced it. Actually, it was about a year and 3 months we refinanced that. We did take cash flow. I learned early on not to do this, but on that deal, we just took cash flow and used it to make the improvements and refinanced it. Got all of our equity out within about a year and a half, call it, and then ended up selling it 5 years later for $6.5 million. So sold it
Wow.
10 times what we
Jeez.
bought it for. Yeah, it was a
So
home run.
what when you said that you took the cash flow and that you learned not to do that, what does that mean?
Yeah, you really shouldn't buy properties and plan to use the cash flow from the property to make improvements, right? Your construction budget should be planned out really well in
Yeah.
advance, and you should be setting those funds aside upfront before you close on the property to make sure that you got all the money to make those improvements. Because if you just plan for the cash flow to be enough to be able to support all those improvements, you might have some surprises and you might not have as much money as you think to get that work done. Now, thankfully, it was a crazy deal. I mean, it was
Yeah.
57 lots at call it 400 something dollars a month for that price. It
Yeah.
was just an insane
Unheard
deal,
of.
right?
That's
Yeah, yeah.
good luck finding that today.
So that's what I'm saying. We did that deal that way, but it could have went really bad. I mean,
Yeah.
it could have ended up much different, and thankfully it didn't. But Yeah. So always reserve the improvement dollars up front, know how much work you got. We knew what work was needed, but we kind of went, oh yeah, in year one, we'll make this much cash flow. We'll just take the cash flow. We won't do distributions. But, and it worked, but I wouldn't do it that way again.
Yeah. So I guess that's one of the things. What's another thing you've learned from, you started with 0 up to 1,200 units of mobile home parks. What is something that you might have been doing at 300 to 400 units that you would maybe change
Yeah.
today?
Yeah. All right. So this is the thing. Okay. Everybody wants to hire someone that they can train, right? Because it's less expensive.
Yeah.
And with community managers, you can kind of take on entry level people and train them. That's fine. But when you start hiring like management level people or anyone that's kind of more on the corporate side, you could call it, I started out hiring people that I needed to teach. The problem was I was only in the business for 2 years. So what do I really know, right? I'm going
Yeah.
to teach them something that I've learned in the last 2 years and probably haven't bumped my head on it yet. So I think the trick is, and it's hard, like I understand everybody is trying to stretch a dollar, but what we do is we try and stretch that dollar and hire inexperienced people, and then we try and teach them from our inexperience. I don't care if you've taken education, anything like that. You just don't know what you don't know, right? I'm still learning things 12 years in, right? So uh, you go cheap, you get bad results, you have much higher turnover, and it's going to take you a lot longer to grow a good business. And I think the realization that I had to come into was in the beginning, I was thinking like an investor. Okay.
Mhm.
When I went from single family house flipping, that was a business, right? I had operations, I had systems, we had marketing, all of that. And then when I went into commercial real estate, I thought, which is why I really failed to find apartments, was I kind of thought that I had to become an investor. And what do investors do? Just think like the natural process of an investor. They log in, they buy some stocks, they buy some bonds, everything is fairly passive, right? And a lot of times we think we're just going to go find a broker, kiss butt until they bring us a deal that's maybe off market or maybe not. And we're going to buy that. We're going to hire a management company and everything is going to be great. I'm going to get checks. I'm going to get reports and game over, right? I'm retired. Well, in my mind, subconsciously, I was just looking for deals like a passive investor would. And when I realized that I had to shift from an investor mindset, like if you think of like the cash flow quadrant, employee, self-employed, business owner, and investor, when we think commercial real estate, a lot of times people go, I want to be an investor. It's not the case. You're actually going into the business category. And so you have to start thinking like a business owner and you've got to start thinking like systems. How do I put, cash flow or I'm sorry, deal flow processes in place? I've got to understand the operations. I've got to understand all these things that you have to know in business, not as an investor. So circling back around, when you recruit people, you have to recruit people that are smarter than you and have more experience than you, right? And in the beginning, I hired people that didn't for the most part. And like, if I barely know what I'm doing, how am I going to teach somebody? So now I only recruit people who have more experience. Like, guy I'm recruiting right now, like 20 plus years in commercial real estate. Our asset manager, 30 something years in commercial real estate and heavy in the MH space before. It's hard to do, but you got to stretch to kind of find really solid people. And then your company will grow and become much more organized and professional. Entrepreneurs think that they know everything, but really we don't know anything. We just got vision, right?
Yeah.
And some energy. So yeah,
Yeah, definitely. And I think that
recruit up.
there was something that I actually heard Alex Hormozy say it this morning. I was listening to him and he was saying the people that make it to where there's no meat on the bone for anybody usually don't grow eventually, because that's an investor approach. Is like, how do I make the best deal out of this? It's like, but if you have like, I guess, employees and stuff, it's like you have to give them some to grow as well.
Yeah.
And you can't be just trying to squeeze every penny out of them as well.
Yeah.
And that's been my experience, is through just trying to, give people bonuses when they need them, and, reward them and stuff, and, do the extra stuff like going out, buying lunch for the office and stuff. But my
Yeah.
business partner, he was very, as he should be, is very tight on the wallet. And I was kind of like, I came from corporate background from a REIT that's kind of
Yeah.
like way larger, so
Yeah. They're
yeah.
used to paying.
Yes,
Yeah.
but I could see the benefit of it. Like, I would say that there's people at my old company where I used to work at, I would be like, I could pick like 10 people from that company, and if they worked for me, they would make my company way better.
Yes.
And that's because they're operating at a large scale. The only
Yes.
way to operate at a large scale is to hire qualified people, which is very hard to do, especially when you're new,
Yes.
dysfunctional, you know, dealing with pick somebody out of that corporate environment and put them into your 500 unit to a 1,200 unit portfolio.
Yeah.
You have to like give them the vision. Like, look, this is where we're going.
Yes. Yeah, they're coming from a place where they have large budgets.
Yeah.
they have corporate structure, they have culture, they have all of that, and then they come into your company, you're like, going, "What the heck is this? This isn't even a business. This is just some guys who wanna buy deals," right?
Yeah. Yep.
And that's the difference. It is hard, and it's hard to attract high quality people, and it doesn't mean that you're going for 200 plus $1,000 a year salary people, but you're finding people who have at least have experience that maybe wanna make their next move up. Maybe they came from a regional position, and they're gonna be head of your property management, or maybe they've been a really good multi-site community manager, and they're gonna be your regional. So it's kind of like they've got more experience, but they haven't maybe been at that level, and this is their opportunity to get there. So yeah, I totally agree with you. I'm doing a deal right now. Well, deal. Listen to me. Hiring potentially someone, and I'm scared. Like I'm looking at the salary and I'm going, never hired someone at that number before, but the experience and background is, I know it's going to be a good investment. It's just even at this level, I'm still pushing the envelope and going, all right, I need these kind of A players. I'm willing to pay for it.
Hey guys, if you want to learn more about our deals we're investing in, go to our website and sign up for our free ebook, 10 Reasons Mobile Home Parks Outperform Other Real Estate Investments. We won't spam you. We'll just keep you updated on the podcast and the deals we're working on. Now, back to the show. The other scary part about hiring those people that you're talking about is like the higher level people is that, like with my experience, we're hiring people that are, making, this might sound bad, but like a replaceable income.
Sure.
But when you bring somebody in to make 150 to 200,000, this person's got a mortgage, they have a family, everything's, so you're like, I don't want to bring this person on and it doesn't work and then I have
Yeah.
to let them go because they have a lot rely on us, but
Yeah.
also vice versa, so it's kind of like there's a lot of pressure.
Welcome to entrepreneurship. There's a
Yeah.
lot of responsibility that we carry, not only for our own families, but for the people that rely on us. And it's important. And you think about it too, like if you make some bad hires and they're expensive, um, and then you got to replace that could potentially, especially as a small business, that could really affect your company to where it could affect other employees
Yep.
too, potentially if you really screw it up. So yeah, I think it's just being um, thoughtful, taking your time to hire. That's really hard to do because when you're small and scrappy and you need somebody, you're like, you fog a mirror, let's go, and you'll take the job. All right, I'll hire you. But that's and I've done that. But I think really the most important thing is that you do slow the pace, get to know the person, especially for key hires. Like,
Yeah.
take your time getting to know them. I actually trying to think of the book. I'll think of it in a second, but,
Who
I
who
read
not how?
yeah, Who Not How is a very good book, by the way. But it was the saying was, "Work with someone before you work with someone."
Mhm.
And that means is if you can if you're thinking about hiring someone, find a project for them to do, maybe a small consulting project, or even if it's just a test run. Like, "Here, we'll pay you to do this small project. Let's see how it goes." And that way you get to really see them in action. And yes, you don't want to have them do it for free because then you're not going to get the same, level of activity out of them. But if you pay them, it's a much less riskier proposition than to hire someone. And so I've started doing that a lot. Like I try and figure out where can I get you to do a little consulting project for me for the next few weeks and see if we work well together. And it's a pretty cost effective way to test someone out.
So you're in mobile homes, and then you start to, I guess, I don't know if it's considered pivoting, but you've found other assets. What made you get into doing like storage units?
Well, it's interesting. When we were looking at apartments, we decided that we wanted to go into apartments. Number one, because it was something that we were familiar with, right?
Yeah.
Coming from the single family space, you kind of know that tenant and all that. But we wanted to buy assets that were going to perform when the economy got ugly. Because if you think around 2000, this is kind of funny. 2013, 2008 was the bottom. 2008, 2009, then the market starts coming up. Things are getting hot again. New construction is happening, and we're going, okay, this is getting really aggressive. It'll bust again at some point. We knew that the market was cyclical, so we wanted to own things that would do well when the economy crashed again. And we knew apartments would do well, especially class B and C. And we knew that self storage was going to do well. And so I always had in the back of my mind that I wanted to own storage. And it was a good hedge against inflation because you can keep up with rents. It's month to month rent or leases and things like that. And so stumbled across the mobile home park, went down that road and still had an eye out for storage. And that's kind of, I did some marketing. So let's see if we can pick one up. And we did. We bought one really close to us again in Naples, which was great because the first deal we bought was in our backyard again
Yeah.
for storage. And it was 50,000 square feet, probably. So good sized facilities, something we could really learn from, and worked out well. But yeah, I think it was just, I tend to like property types that can be purchased from mom and pop owners
Mhm.
that have a lot of value add opportunity and are going to perform well in, poor economies, and consolidating, which both mobile home parks, storage is definitely later stage consolidation than, let's say, mobile home parks or RV or small Bay Light Industrial is kind of consolidating right now too.
So what do you think, like, when you get to, like, we'll just say you have over $100 million in assets under management. At what point do you either stop taking investors' money to buy real estate on your own, or what is the vision? Like, why do you keep going?
Yeah, good question. There is that opportunity. We could just sell, or we could buy out, or we could do some strategic plays to free up cash. We're pretty low loan to value on our portfolio. We really have never taken out cash above what was initially invested. So our loan to value portfolio wide is in the low 50% range. And so we could do that. Number one, our investors are like my friends, so
Yeah.
I really enjoy working with them. We call them capital partners, even, they are LPs, but we really treat them like partners. We tell them what's going on and we take their input. So in that sense, I have zero buyout agreements for them. So I have no interest in doing that. I would say if we were going to sell, we'd, probably sell together. And our vision is to, or at least our vision for the next, it was 10 years. We got about 8 years left, is by 2032 to be at $1 billion in assets under management. And at that point, we've got enough scale to where if we have a REIT, if we have a large PE firm that wants to come in and buy us out, now we've got a platform. We've got enough scale to where it's interesting to them, and we'll get a very high premium on that cash flow versus selling, 5 communities or $100 million in assets. It's just a whole nother level. And so we're really maximizing the valuation by exceeding $1 billion in assets. And so by 2032, we'll be there. And, at that point, I don't know that we're going to necessarily sell. We'll continue to grow and do what we want, but at least we know we're kind of in a position where we could go to market if we decided at any point in the future. I'm really in this for the long-term cash flow, to be honest. We buy these things with 10-year hold horizon on each of them.
Okay, that was what my next question is going to be. Is just like, so you're talking to your investors and they ask you, how long do you think you'll own this property?
10 or more.
10 or more, and I really like that as well, because I think with the mobile home parks, I would say it's very underestimated on how hard they are to find. And then when you
Yes.
find them, you're like, okay, I got them, and then you're like, how are we going to sell this? It's like, now it's operating. It's like,
Yeah.
the longer you hold it, the better it gets. Most
That
of
deal
them.
that I sold first, that first deal,
Yeah,
I did not want to sell that park. We'd owned it 5
that's a hard
years
one.
and we were cash flowing. I want to say it's 28,000 a month or something like that, net
Yeah,
net. And it's kind of like,
yeah.
that's a really good deal.
$6 million or
Si-
$28,000 a month.
yes. And so, it was a very hard decision. But when they came and said, "Hey, we'll pay 6.5 million for it," we knew that the value was stretched, and we're like, "Okay, that one we might want to take." But I had some sleepless nights, and when we sold it, we were celebrating, but in the back of my head, I'm like, I don't know if I wanted to sell that one. Every time I drive by it, I miss it. But at the same time, who gets a 10x, not 10x return, 10x sale price? That's pretty rare, right? So I'm
Yeah.
glad we took it. It definitely skewed our average IRR and average returns in our portfolio on that one. So, but yeah, I think buy and hold on manufactured housing is really solid. There was just a recent transaction where it was about 80 or 90 communities that just sold a large portfolio
Yeah.
for, a couple billion or something like that. And I think it came out to be about 125. Are you familiar with that transaction?
Was that Bercadia that sold it? I think.
I don't know. I don't think it was Bricadia. But either way, they
Yeah.
sold for like 125 or 135 a site.
Yeah. I have heard about it just recently.
Yeah.
Somebody told
And
me
I'm
about
like,
it.
crap, we're buying at like 35,000 a site.
Yeah.
There's massive, massive upside. And that's today.
Yes.
Give it 5 years, give it
Yes.
10 years when everything is consolidated and everybody's buying from professional operators, and it's much like most of the other asset classes.
Yeah.
We will be sitting on gold. And it's only increasing in demand and decreasing in supply. So it's not like you can build these, at any scale. It's very difficult to do. So I really don't want to sell them. And it's great because we can offer a really good product in the marketplace, affordable housing. It's great to be able to help people too.
I think back to the Naples deal, or the one that you sold. The reason why I think it's great to sell a few once in a while is it's okay to take chips off the table, establish yourself, build the balance sheet, because a lot of these. When you sign the loans, are you doing non-recourse, or you're doing mostly non-recourse, or is it personal guarantees?
When we buy them, we either buy them with seller financing and sometimes bank financing. I would say it's probably 2/3, 1/3. 2/3 bank financing, 1/3 seller financing. And those banks always want recourse. And our strategy is to buy them, get them stabilized, refinance into long-term non-recourse debt. So like we've done a lot of CMBS in the past, a little bit of agency, some life companies, but the whole goal is
Nice.
to get to non-recourse. Yeah, and that's why size matters too. If you're
Yes.
buying little deals with loans like $500,000 or something, it's just very hard to get that higher quality debt that's going to get that off your personal financial statement, so you don't have all that contingent liability there.
Yeah. And I think somebody pointed that out to us because almost we don't have any non-recourse stuff. So
Yeah.
it's a thought for sure.
Well, and what's interesting, I laugh when I hear people say, "Oh, if you're not willing to sign on the loan, you don't believe in the deal." No, I'm not an idiot. Like,
Yeah.
if I don't, I'll sign on the loan to get us in, but I want to get out of that as soon as possible. If you're buying like one or two properties, fine. But if you're really trying to scale a portfolio, it will become a problem in the future from a financing standpoint. And also, why take on the additional risk? That doesn't mean that you're that much more committed to the deal. It
Yeah.
means that you're going to go bankrupt if everything hits the fan at the same time. It's just bad business. And so I don't necessarily believe in that.
Yeah. I'm not definitely, if we had non-recourse, we'd get it. But I think so somebody actually pointed it out. It says eventually the banks aren't going to, as long as you're personally guaranteeing all of it, eventually
Yeah.
they won't want you, you'll have too much on your balance sheet for sure.
They'll look at you and say you're pretty top heavy, especially, if you think about it, if you've got a lot of LPs and they
Yeah.
own a large percentage of the deal and you're taking on all the debt, there's kind of a mismatch there in equity to debt ratio. So they're going to eventually start to say, I think you need to get caught up a little bit here before we can give you more. So the whole goal is get the property stabilized, get into that non-recourse long-term fixed rate debt, and let it ride.
Yeah, so I really think this podcast is for me personally, just because
Good.
I want to be like you're like the next step for us. I'd like to think.
Good.
So real quick with the one question I had was with the I kind of lost my train of thought, but
That's fine.
with I
Well,
lost it.
I'll let it come back. All right.
Yeah,
So
yeah, yeah,
don't
yeah.
worry. So I think what's important too is when you're buying assets, and this is mobile home parks, this is anything, you should always think about, does somebody else want this asset? Because I think another mistake that people make in the beginning is they buy things that are cheap. They go,
Mhm.
I'll buy this 20 space park that's got 10 homes in it or 5 homes in it because it's cheap and they can afford it. And that's a huge mistake because number one, that 20 space park with 5 homes in it is going to be a nightmare for the next couple of years. Okay. It's going to slow you down from buying the next deal and cleaner deals, right? Because you're going to be so focused on that. And on top of that, you can always raise the money to do bigger deals. And then, we talk about the financing on the back end and all that. There's going to be a lot less buyers for a 20 space park than a 50 or 100 space park, right? And same thing with the financing. There's going to be a lot more financing options when that loan balance is over $1 million than when it's under. So I think you just need to I always think that I want to own things that other people want. If it's in a crappy neighborhood, but I can buy it cheap, I don't want it. Why? Because nobody else wants it. So I'm going to have a hard time on the back end financing and reselling. And it's a hard thing to get over because it means you're probably paying a premium, over that trashy little park in the country. But you will be glad you did because it'll be much more stable. You'll have much more demand for it, both on the financing and the resale, but also for your tenant base. You buy stuff in the boonies because it's cheap, you're going to regret that. And so buy things that other people want. And I get perfect example. I get people that I was getting some people that were hitting me up about this park for a long time. It's probably 2 or 3 years straight. People would hit me up every few months, be like, "Yeah, I got this really good deal. It was in Ohio or something. Like, it's a really good deal. It's 200 spaces, like super clean, institutional quality, and you could buy it like a 12 cap." I'm like, all right, this just sounds really good. and we talked briefly, and then I go, oh, it's that one. And it was on a landfill,
Oh,
right?
oh,
But keep in mind that the new phase one came back clean and everything was good. It was compliant. Yeah, I don't care. Nobody's going to want that. And so, yeah, you can buy it and get a crazy return, but the back end financing and sale is always going to be just a nightmare. And these people were trying to sell that park for years. I don't know if it ever traded, but I don't care if it's compliant. It's in a horrible location because it was once a super dirty site. So it's kind of like, look at the big picture.
yeah. Also,
Location matters.
also with the more desirable properties becomes quote unquote cheaper money. So cheaper money will also drive the values up as well,
Yes.
is what you're
Yeah.
saying. Just
Yeah, the debt and the equity is going to cost them less.
Yep.
You have bigger institutional capital behind it.
Yep.
So they're willing to pay the premium because often, especially in like family offices and things like that, they're thinking much longer term.
Yep.
If private equity is usually a shorter investment horizon, but they're willing to spend the extra dollars for the higher quality. Now, don't get me wrong, I'm not going out and buying 5-star communities that are super clean, and I'm not. Like if you drive through my parks, you're gonna be like, nothing pretty about this thing. You know what I mean? It doesn't mean that we haven't improved it, but
Yeah.
they're older communities and that's okay. But The key is be in a location where there's demand, be in a location where there's going to be, a resale or financing opportunity on the back end. Just buy things that are relatively stable. We buy value add, and sometimes pretty distressed, but they're predictable business plans to get them stabilized. Like, we're not buying super low occupancy communities. I don't think I've bought anything that was under maybe 70% occupied. Then you got the new guy who goes and buys a park that's 75% vacant. And you're like,
Yeah.
dude, you don't know what you just bought. You got 5, 6, 7 years, if not more, to get that thing filled up. And by the way, you've got a loan coming due in 5. So you're gonna have some sleepless nights on that one. I don't want to
It
mess with
sounds
that.
like a familiar story for sure.
Yeah, hopefully not too familiar.
No,
Yeah,
I mean,
yeah,
it's true, and
yeah,
I met with these one capital guys one time, and they were doing apartments, but they were talking about, we like to buy value add, but we're not doing heavy value add, because
yeah,
the heavy value add, investors are looking for their money to come back within 2 to 3 years. And when you get into those heavy value adds, you're pretty much working with your investors, getting through all these deals, and they eventually run out of cash, or they don't
yep,
run out of capital, but they stop giving you capital because they want to see you execute. And if
yes,
you're unable to execute in the time frame, you're literally you'll run out of investors' capital. And we're kind of in that somewhat position, because we bought all these
mm,
super heavy value add deals, and
yep,
you learn stuff from
sure.
that. It's I'm sure you had that same experience.
I bought a couple I probably wouldn't buy again. Yep.
Yeah.
Yeah,
So
I think, again, if it's cheap and you can get rich on it, looks good, right? I mean, that's
yeah.
what people see. They go, man, if we just fill up this 100 space community, we just got 75 sites to fill. We can do that in 3 years. And, they're like, look how much we're going to make on this. And they see the big upside on that, but they kind of miss the downside risk.
Mhm.
And yeah, you're going to get really rich doing that deal, but you're gonna risk everything. And so in the beginning, I think people do more of those deals because they're just trying to get going, and they're less expensive deals, and they
Less
look
people
like good
going for them
upside.
as well.
Less people going for them, right? There's less competition. So it makes sense, but you do a couple of those and then you go, okay, let's be a little bit more measured here and buy deals that we know we can get stabilized in 1 to 2 years max,
Yeah.
lighter strategies that aren't quite as capital intense and things like that. And you can just execute better. So leave the really heavy lifts to the crazy guys.
Yeah.
There's some people that are really, really good at infill. They can just bring in a ton of homes. They're very systematic about it, and they do it at scale. Let them do those kind of deals.
Yeah. So, the question I had before was, have you ever done? So we've mainly done only syndications.
Mhm.
Have you been able to do, like, execute on a fund, or how do you mainly do your capital raising?
For, call it, 9 years, 10 years, roughly, we syndicated
Yeah.
every deal. And we looked at starting a fund probably 3 different times. And every time we kinda came back to it, and I know having a fund sounds sexy, but there are some complexities to it that we just couldn't justify. And we're like, "Well, we don't wanna take a bunch of cash and do like a blind pool fund, take a bunch of cash and then be forced to go out and deploy that capital quickly," because I've seen a lot of guys do that, and a lot of times they just buy crap deals.
Hmm.
They're just overpaying for things just to get the money out because they got the pref burning a hole in their pocket. So they deploy capital too rapidly. They buy deals they probably wouldn't have bought, and it just puts them in a tough position. We also knew that our investors were very deal focused, like they wanted to understand the deal. They're pretty
Yeah.
sophisticated people. And going from that to a blind pool is challenging because you have to get them to just trust you that you're going to buy good deals. And if you don't have a really big track record, it's hard to do that. So we do have a fund now. We started a fund last year, and we're still raising just as we go. We're actually not just blindly raising capital. It's just as we have a deal, we raise the money for it, and it's a pretty unique structure. So it kind of covered some of the issues that we were having in the fund structure before. It's kind of a hybrid between a fund and a syndication. So our investors actually get to pick and choose which assets they're in. It's pretty cool. But what I would say is there's really no need to go into the fund structure, especially in the beginning. Build your track record. We could say, hey, we've been doing this for 10 years. This is our portfolio. This is what we've done. And we just pretty much went to our existing investors and said, hey, it's going to feel a lot the same, but there are some benefits to our structure here. And it transitioned fine. But it's much harder in the beginning to get people interested in a fund.
So when you can, if say people can invest throughout the fund, like, I understand, like, there's like a committed amount and then they come up with the cash. But as what you're saying is that they can choose or not choose to move forward with it. Like,
Correct. Yeah,
how
they
does
well,
that
they
look
can
like on,
choose.
like, a ownership percentage? Like,
Yeah,
say the
so
first investor gets in, then you have the next tranche of deals. How does that work?
yeah, so it's by classes, and it's
Mhm.
through. We've got some pretty interesting software that segregates that out. But
Mhm.
basically, when for each deal, once that deal is fully raised, you can't participate in that past deal anymore. So it feels a lot like a syndication in the sense that they get to pick and choose which assets they jump into. But once that's raised, they can't participate in that anymore. So it's really not, they're not getting the diversification across the entire fund like a traditional fund would, but they get one single K1. So it's nice for them. And for us, it reduced our securities and legal costs significantly because with a fund, you spend the money up front. And if you have an investor in a new state, you've got a blue sky filing once. You don't have to do that every time you syndicate a deal. So we put the fund together and we've already recouped all the fund expenses and now everything, if you do the math, if you're syndicating, it's like $15,000, $20,000 for someone who's syndicating on small level. It's pretty expensive. You do 5 deals in a year. That's a lot of money in legal costs that has to be recouped. Now, if we take an investor from a new state, we've got a little bit of blue sky filings, a few $100, maybe $1,000 in the expensive states, but that's very manageable compared to 15,000 per syndication. You know what I mean? So yeah, it's kind of a cool structure and, I don't want to say proprietary, but very unique. Very few people I've ever seen have it. So
awesome. So where can people find you?
Yeah, easiest way is all over social media. And you can also go to mariodattilo.net. It's got all my companies, everything I've got going on, my education company that teaches people how to invest in mobile home parks, our fund, all of that. Very easy to find. Put my name in, it'll pop up.
It'll come up even when you don't ask for it.
Yeah, I think there's really yeah, exactly. You know that. I think there's really 2 people that I can help a lot. The active investor, especially someone who wants to be in the manufactured housing space, I can teach that person how to go out and skip all the mistakes that I made over the last going on 12 years through my education. And then for the passive investor, somebody who says, hey, I just want to own these things, whether it's mobile home parks or the other asset classes we invest in, skip the work and just collect a check.
Awesome. Well, it was great having you on and thanks for coming on.
Thanks for having me on, Glenn.
Thank you for listening to the Millionaire Journey podcast. Please rate, like, subscribe, leave a comment, and share with somebody you think would enjoy listening.